Hello folks, it is Wednesday morning. We're going to get to the charts. We got a little bit of news to talk about. Let's get right to it. The markets are back into risk on mode based on a hot, and I'm doing air quotes with my fingers now, hot jobs report, and air quotes again, a soft inflation report. And so those two reports have people putting money back into stocks. Precious metals sector is weak because we're back into risk on mode. So this is the jobs report. It came out on August 5th. The headline number is that we added 528,000 jobs in July. So that's the headline number. And expectations were only for 250,000 new jobs. And so that's more than double what the expectations were. But when you dig into the actual numbers, without the seasonal adjustments, we actually lost 385,000 jobs. The BLS, Bureau of Lying Statistics, added 913,000 jobs via their seasonal adjustments. So basically it's, pull a number out of your ass, and this month the number was 913,000 jobs. What will happen in subsequent months is that this number will be revised back downwards, but it won't be as part of an official report, so nobody will talk about it. And so anyway, this number will be revised down. What this means going forward is that this positive jobs picture, based on this report, 528,000 new jobs were added, it means the Fed needs to keep raising rates to prevent the economy from overheating. And so at the September FOMC meeting, where they adjust interest rates again, or may adjust interest rates again, expectation is that they'll add another 0.75 of a point. The next report was the CPI. And so the headline number in this case was 8.5%. There we go. So 8.5% is the CPI before seasonal adjustments. Prior month it was 9.1%. And so what this is, the way this is being presented by the talking heads is that, inflation has peaked, it's coming down, and prices are coming down. Well, that's bullshit. Prices are still rising at an 8.5% rate. It's like, okay, last month they were only rising at 9.1%, but they are still rising. And that's the key point. Prices are still going up. And so any kind of positive spin you want to put on the CPI report is just spin. Prices are still rising, and they're rising at, this is still a 40-year high. Inflation has not been this high for 40 years. So, discount any positive spin that anybody tries to put on the CPI report. Again, based on this report, the Fed needs to keep raising rates in order to fight inflation. And I have fight inflation in quotes because that's just a smoke screen. That's the cover story. They're saying that they want to fight inflation. Reality is raising rates lets them pump more money into the banking system through their IORB mechanism. And I talked about this in a recent video. This is an article on JS Mindset. This writer, Stan Szymanski, sorry Stan, is explaining that the IORB is just another mechanism for the central bank to pump printing press money into the Federal Reserve banking system, the 36 banks that make up the Federal Reserve banking system. As interest rates rise, the Fed is able and does pay higher interest rates to the banks in the Federal Reserve System. And that's what we're seeing here in this chart, is that each time the Fed has raised interest rates, the interest that they are paying on reserve balances goes up. So they're able to increase every month that they raise rates. They increase the amount of money, printing press money, that they're handing out to the Federal Reserve banks. What was explained, I'll just real quickly, what Stan explains in this article is that the Federal Reserve prints up money, gives it to the 36 banks in the system, and then pays those banks interest on the money that it gave them. Pays, more printing press money to pay them interest on the printing press money that they gave them in the first place. As interest rates rise, the interest that the Fed is paying to those 36 banks goes up. And so what they're telling us is that they're fighting inflation. In reality, what they are doing is pumping liquidity into the banking system. Because remember, in the background, what's going on, we are in the midst of a global debt collapse. It started in December of 2021 when Evergrande defaulted on its $300 billion in debt. And so that global debt collapse is ongoing. And the Fed fighting inflation is just a smokescreen. Okay, let's jump into the charts. So this is gold in the weekly time frame. So gold is trying to go higher. It wants to go higher. It's pushed up through the 10-week moving average. It's trying to break out of the top of this downward sloping channel. As I suggested in my last video, what this looks like, is just a counter trend rally that wants to roll over and head lower. And until we get a decisive break higher, that remains my viewpoint on this. MACD is still in bear mode, which suggests that the primary trend is downwards. Energy, based on stochastics, is rising sharply, about 2/3 up the scale. So let's look at gold in the daily time frame. So gold is flirting with this $1,800 round number, which is also a horizontal support resistance level, pushed above it earlier this week, and is now today kind of soft around that 1,800. Looks like we're at 1,808 right now. Finding support on the 20-day moving average. We've got the 50-day moving average below that. MACD has moved all the way up into bull mode, so that suggests that the primary trend in the daily time frame is up, and then energy quite elevated. So gold is certainly poised to move higher, all the way up to, I would guess, 1842 or so at the 200-day moving average. But again, I'm waiting to see a decisive break higher before I would say that that's definitely what's going to happen. Silver in the weekly time frame, very similar to gold, trying to push through the 10-week moving average, playing with support along the lower median line of this modified shift pitchfork. MACD is in bear mode, trying to turn up. Based on MACD histogram, it looks like we're close to getting a new buy signal in the weekly time frame. Energy mid-range rising sharply. Silver in the daily time frame, again flirting with this horizontal support resistance level, finding support on the 50 and 20-day moving averages. MACD in bull mode, energy very elevated. So again, silver is poised to move higher. The markets are back in risk on mode, and so precious metals are out of favor relative to stocks. So this GDXJ, this is my proxy for the mining stocks. It has broken higher somewhat. It's popped above this horizontal support resistance level, flirting with support and resistance along the 50-day moving average. Obviously, the 20-day moving average is acting as support. Immediately overhead, we've got this support resistance zone. So even with a strong move higher in the mining stocks, we've got overhead resistance to deal with. MACD in bull mode on a buy signal. Energy is elevated. So, the US dollar. So this is in the weekly time frame. We've got the dollar softening and finding support currently on this horizontal support resistance level. Has dropped below the 10-week moving average. Got a little bit of a lower wick on this candle, suggesting that the dollar is trying to bounce from this level. MACD is in bull mode. Looks like we've got a new sell signal. So sell signal on MACD in the weekly time frame. Energy coming down from its very elevated level. So softening in the dollar in the weekly time frame. Here in the daily time frame, we can see that the dollar has dropped below the lower median line of this modified shift pitchfork. That was yesterday, and now today has dropped below the 50-day moving average and is finding resistance at that level, playing with support along this horizontal support resistance level. We'll see at the end of the day where the dollar ends up. MACD in bull mode, but on a sell signal, and the downward movement accelerating based on histogram. See how it goes from soft red to dark red. Suggests that the downward movement or momentum is strengthening. Energy is very low based on stochastics. So we may continue to see weakening in the US dollar, which nominally would be positive for the precious metals. But again, the markets are in risk on mode. Here, this is Bitcoin in the daily time frame. Again, suggesting risk on mode. Bitcoin's getting a little bit of a bid, breaking above the 50-day moving average, which has been holding it back for several weeks now, the last 2 weeks, and now popping higher today. Equity markets, this is S&P 500 in the daily time frame. We can see that yesterday we got this big gap. So we were sitting, let's see, that would have been Monday, we were sitting on support, and then Tuesday we got this big gap higher based on CPI report, the quote unquote again, the soft CPI report. We got this gap higher in stocks. And a strong candle, price closed near its high of the day. That's a bullish candlestick. Now today, price has gapped up again, but pushing up into the median line of this Andrews pitchfork and found resistance there. It's early in the trading day still, but has pushed up into resistance and pulled back. And so that's where we're at currently. And let me point out, this is too steep a price movement to be sustainable. Price does not move at this level of steepness in a sustainable manner. And so reasonable to expect whether we get a pullback or just some sideways bumping, not really realistic to expect S&P 500 to push higher. It's already moving at a very steep rate. MACD in bull mode on a buy signal, energy very elevated. So the stocks are poised. I'll do a separate video. I looked last night at the equity markets in both the monthly and weekly time frames. And we're probably in for several weeks of upward movement in the equity markets. So again, risk on, probably through September. Let's see. This chart is showing in the top frame, we're looking at S&P 500 in the monthly time frame. In the lower chart, we're seeing this is S&P 500 relative to gold. And what I want to show in this chart, and Franklin Sanders, the money changer, he points this out regularly, that regardless of what the stock markets are doing in nominal numbers, so this is the stock market measured in US dollars, this is the stock market measured in gold. And so for the last 20 years, since January of 2000, the equity markets are losing money relative to gold. For the last 20 years, you would have been better off to have your money in physical gold than in the stock market. But of course, because of inflation, the games that are played, that's not what it looks like. When you look at the stock market measured in US dollars, it looks like you're making money by being in stocks. Not the case, folks. Pay attention to the stock market relative to gold or silver, take your pick. Let's keep rolling. This is the Dow in the daily time frame, very similar to S&P 500. Big gap higher yesterday on the CPI report, another gap higher today, but pushing into resistance and pulling back. MACD in bull mode on a buy signal, energy very elevated. Same story here. This is the Dow relative to gold. And again, for the last 20 years, you would have been better off having your money in physical gold than in the stock market. And Franklin Sanders points that out on a regular basis. Here's the NASDAQ daily time frame. Same thing, gap higher, currently pulling or pushing into resistance and pulling back. MACD in bull mode on a buy signal, energy very elevated. Let's take a quick look at the debt markets. This is my favorite chart for the debt markets. This is the 1-year Treasury bill in the monthly time frame. And when it makes vertical movements, bad things are happening in the economy. So, that was 2008. That was the big scary plunge. And now there's a number of things going on right now. But again, a vertical movement. Vertical movement in this chart is not a good thing for the economy. I added this morning. This is June. This is when the ECB and the Fed started buying up debt hand over fist. And the reason they did that is because interest rates were spiking higher, been spiking higher for months. And then in June, they made this just huge move to the upside. And so the ECB and the Fed both stepped in, started buying debt instruments as all durations, 1 year, 30 year, all across the board, municipal, corporate, and government. And of course, the ECB has made it official week before last with their unlimited buying of government bond throughout the EU zone. I saw an article over the weekend. Currently, both Spain and Greece, the ECB is the only buyer of bonds in those countries. And so without the ECB buying Spanish and Grecian bonds, both of those countries would be in a world of hurt. They wouldn't have anybody to sell their debt to. And there again, sell their debt. Keep in mind that we are in a debt-based economy globally. We have to keep increasing debt or the economy collapses. And of course, we have a debt collapse going on in the background, and both the Fed and the ECB and probably all the other central banks are madly printing money trying to prevent that debt collapse from occurring. So anyway, let's keep rolling. This is the 10-year, the yield on the 10-year note in the daily time frame. Big pullback from its peak this, again, this was mid-June. This is when ECB and the Fed started buying debt. They've accomplished a lot. The move like this doesn't occur without central bank buying. The underlying trend, in my opinion, where the market naturally wants to go is taking interest rates higher. And so every time the central banks back off on their buying, interest rates try to move back higher. And so that's what we've had this week. There was, or that was Friday, a pop higher, and now today we've got a pop higher in the 10-year note. Stochastics, energy rising sharply and very elevated. We've got a new buy signal in MACD, although MACD is in bear mode. So again, the trend, the primary trend based on MACD is downwards. And in my opinion, that primary trend only exists because the central banks are buying debt. The natural trend is for interest rates to move higher. And that's what this, new buy signal is suggesting. Interest rates want to move higher. That's the last chart I've got. The overall message is that the markets are back in risk on mode. We've probably got several weeks of moving higher in the equity markets, although for the next couple of days we're likely to see sideways action. So anyway, a couple of weeks of stocks moving higher, probably going to see continued weakness in the precious metals sector because the market thinks that the economy is strong and inflation is soft. And of course, that's just not reality. So enjoy the rest of your day, the rest of the week, and I will talk to you soon, folks.